a tale of two US dollar indexes diverging. So recently there's been weakness in the US dollar index, which is mostly the dollar against the euro, the Japanese yen, the British pound, and a couple other currencies. Although the dollar versus the euro is the major weighting, it's around 57%, give or take. The dollar index has been very weak lately on comments from Federal Reserve Board of Governors about rate cuts in the near future as early as the June meeting. And the market is potentially pricing in maybe 4 rate cuts in the next 12 months. But on top of this, you have comments from President Trump about more QE. You have comments from Federal Reserve members about potential QE in the near future. And you also have quantitative tightening, which is the Fed reducing its balance sheet. You have that ending in September officially. And I guess some Fed members might want it to end sooner. And once we go to QE, that means that the Federal Reserve is going to start expanding its balance sheet again, at least officially. The dollar index, so going back to November 26th of 2018, the dollar index has failed to stay at or above 98. So there's been 6 failed breakout attempts starting on November 26th of 2018. And the dollar index has gotten hammered down from 98. So in the past, the dollar index was higher. In the past, it was lower, but it had higher highs in the past. So 98 appears to be, at least for the last couple of years, that real key major overhead resistance level. It got in April to 98.01 and was hammered back down. And recently, it got to close to 98 again and then got hammered back down. And now today, when I'm recording this on Tuesday, June 11th, 2019, the dollar index is at 96.71. And on this next chart, which Ronald Stuffley put on his Twitter with technical analysis, he shows that the dollar index is actually getting very close to touching or getting below its 200-day moving average. However, and the reason I'm doing this short video is because there is a major divergence. There is also a second dollar index. So the first dollar index, the regular dollar index, or DXY, which you can monitor and follow and look up, that one shows dollar weakness, especially against the euro from what it looks like, because the majority of the dollar index is against the euro. However, the second dollar index is called the trade-weighted US dollar index, or broad index, and it was created about 20 years ago, give or take, by the Federal Reserve. And so the Federal Reserve calculates this. And it measures the dollar on a trade-weighted basis that is adjusted against 26 other currencies, including the euro, Canada, Japan, Mexico, China, the United Kingdom, Taiwan, Korea, Singapore, Hong Kong, Malaysia, Brazil, Switzerland, Thailand, the Philippines, Australia, Indonesia, India, Israel, Saudi Arabia, Russia, Sweden, Argentina, Venezuela, Chile, and Colombia. And that dollar index, and this is the divergence here, that dollar index was just updated again by the Federal Reserve recently, yesterday on June 10th of 2019. And that dollar index is at 129.2028, which is very close to its all-time high. Its other all-time high was in, let me look at this, it looks like 2002, when on January 30th, 2002, when it got to 129.8310. You will see the chart on this, the long-term chart of this. And it also got up to 128.58 in 2016, end of December 28th. This other dollar index is telling a totally different story than the regular dollar index. The trade-weighted dollar index is telling, which measures the dollar against more emerging market currencies, and the emerging market currencies have dollar debt and other problems. The trade-weighted dollar index is telling a totally different story than the dollar index. So which one do you think is right? Now, Raoul Pal from Real Vision, co-founder and former and global macro strategist and former top hedge fund manager, and Brent Johnson of Santiago Capital tend to be in the trade-weighted dollar camp, that they think the trade-weighted dollar is signaling that their dollar is going to get stronger. But the dollar index, the regular dollar index, seems to be at 96.71, showing weakness. So which one do you think is right? This is just a short video, and that's pretty much it for today. So just want to create the conversation and show you guys that, and a lot of people are not talking about this, I noticed this, that there is a divergence between the two different dollar indexes, between the regular dollar index, the old one, which a lot of people say is not good anymore, and the trade weighted US dollar index. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to wallstreetformainstreet.com. That's wallstreetformainst.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.